Hello, my buyer friends. Thanks for coming to my channel. Today we are going to discuss the out-of-pocket cost when you're getting a mortgage to buy a house. The out-of-pocket costs are made up of your down payment and closing costs. Now, what's the down payment? The down payment is a certain amount of money that you put down towards obtaining a loan. The bank wants to know that you have some skin in the game. And so it's usually between 3.5% and 20%, depending on your situation and what you can afford, and depending, of course, on the loan. Of course, there are some zero down payment loans. We'll discuss that in another video. The next thing, cost that comes out of pocket, of course, are your closing costs. What is the closing cost made up of? The closing cost is made up of 1. Lender fees. 2. Escrow and title fees. 3. Recording fees. 4. Appraisal fees. What are lender fees? Lender fees are whatever the lender charges you for the whole process of giving you a loan. There's an administrative cost. There are things they have to cover. Some of them are brokers. They have to look around at different banks and find a loan that suits your situation. They charge you for that service. Escrow and title fees are the fees that the escrow and title company charges you for. What does an escrow and title company do? Title search, that's what one of the things they do. They search around to see if this house truly belongs to the seller and nobody else has a claim to it, and that the seller has a right to transfer title and ownership to you. The escrow company also does something. They hold your down payment in the account. So the down payment does not go to the seller, right? The down payment is held in the escrow company's account, and so they look at the contract between you and the seller, and they make sure that the seller is executing their part of the contract, and that you are, and that at closing everybody has satisfied the contract, and they now transfer the down payment to the seller. There are also recording fees. Recording fees are the fees that the county expects you to pay, so they can record that there was a transfer of ownership between seller and buyer of the property in question. The next fees are your appraisal fees. Appraisal fees are just simply the bank wanting to ascertain that this house is truly market value, that what you're paying for the house and what they are funding is the right amount. So if a house is 450,000 and that's what you want to buy the house at, the appraiser comes in and ensures that that house is truly worth 450,000, and in doing that the bank secures their mortgage. So all of this cost I've told you about will always show up on your loan estimate. When you talk to a lender, they are required to give you a loan estimate within 3 days of the discussion. So when you get your loan estimate, look out for the closing cost. The costs, they are not usually negotiable except maybe the lender fees, but it's good to know so that if you're even comparing two mortgage lenders, you can tell who is giving you a better closing cost from the other, and that will help your decision-making process. I hope this has been helpful to my buyer friends. If you have any questions, drop them in the comment section, and I'll be sure to answer all questions. Take care and do have a nice day. Happy shopping. I hope you find the right house.